Good to go, sir. We can begin, sir. Rinkesh ji.
Yeah, we can begin.
Okay, sir.
Okay.
Morning, all of you. Ritu, madam, please begin.
Good morning, members. Welcome to today's session. It gives me immense pleasure to extend a very warm welcome to you on behalf of Bhayander CP Study Circle. Members, it's our 11th VCM for financial year 21-22. And our today's topic is taxation of financial instrument and cryptocurrency. For today's session, we have very learned and dynamic speaker with us, CA Rinkesh Devnani sir, to explain us the topic. Before moving to technical part of today's session, I request CA Kishore Mehta to formally introduce our today's speaker. Kishore, over to you.
Thank you, Ritu madam, for giving me this opportunity to introduce Rinkesh Devnani bhai. Rinkesh Devnani sir has a main industries specialization are financial services and private equity. He has advised client from a tax and regulatory perspective for investment in and divestment of investment in Indian companies. He has also assisted several large clients on domestic tax and regulatory compliance and advisory matters. He has made several representation to Ministry of Finance and CBDT for direct taxes. He has represented clients for tax and regulatory authorities on various matters. In addition, he assisted several clients on securing regulatory approvals such as approval for foreign investment into India, registration as stockbroker, setting up NBFCs, and many more. He has also written several articles for professional journals and served as a speaker in various industry forums. With this, I would like to request Devnani sir. Sir, the dice is yours.
Thank you very much, and good morning to all participants on this lovely Sunday morning. Thank you for sparing out time and attending this session. So, we'll straight away begin. So the topic for today is tax implications of various financial instruments and cryptocurrencies. Now, as part of financial instruments, there can be a lot of instruments or securities which can form part of which could be called as securities, ranging from equity shares to debt instruments and to some of the new age instruments that we typically now see is about units of AIF, REITs, InvITs, securitization, trust units, etc., including derivatives. So these are the instruments that are available these days in the market, and clearly because of the niche nature of these instruments, taxation issues as well arise in terms of the income being generated from them, as also some of the other issues that we will discuss as we go along. Just before we begin, one or two more things I would like to mention is that let's keep it interactive. As and when the participants have any question, please just put it on the chat box, and as we progress, we'll keep addressing them on an ongoing basis. So the request is not to keep it for the last minute, but rather we have an interactive session as we go along. So we start with some of the basic stuff like when income arises from securities, what is the characterization of that income? Does it qualify as capital gains? Does it qualify as business income? And I'm sure all of you would be aware about the guiding principles in relation to these given by CBDT. Of course, this is the age-old matter, and some of the points that you see on the screen are actually help in determining whether the character of income is capital gains or business income. So clearly the intent with which the investments are bought or the securities are bought, the period for which they are held, the ratio between buying and selling, whether any borrowings have been used or not, all these are indicative or rather help in determining whether the character should be of business or capital gains. Now, with all these directions as well or guiding principles as well, there were litigation on this point, and eventually CBDT came up with some more concrete guiding principles as to what will be capital gains and what will be business income. So somewhere in 2016, CBDT came up with a circular which said that in case of listed securities, if they are held for more than 12 months, then at the choice of the assessee, those shares can be considered as capital assets. Consequently, any gains arising from those shares will be taxed as capital gains. Now, we all know that capital gains tax rates are lesser compared to the business income rate, and therefore, typically people prefer to classify the income from disposal of securities as capital gains. When we compute business income, the additional feature is that the STT that you pay on market transactions is a deductible expenditure, whereas when you have capital gains classification, STT is not a deductible expenditure. But the quantum of STT being so insignificant that it doesn't make any sense to reclassify the income from capital gains to business income. Then this was all about in relation to the listed securities. What about unlisted securities? Now, unlisted securities, again, CBDT issued a circular, or rather a press release, that clarified that unlisted securities shall always be treated as capital gains unless the assessee wants to treat them as business income. Then there are certain caveats to this normal principle. And I'll just draw attention to the third bullet that you may see on the slide. That is, transfer of unlisted shares is made along with control and management of underlying business. If that is the case, then it does not qualify to be capital gains, but it becomes business income. Now, it is anybody's guess that how do you determine that whether the transfer of shares has happened along with control and management of the underlying business? Because typically shareholders of a company are the owners of the company, and when they transfer the shares, by implication, control and management goes with those shares. But nevertheless, this is one of the caveats inserted, and this could be a potential litigation point. Until date, we have not seen in personal experience any litigation on this matter. Moving ahead, so just to kind of summarize the thing, the way it is classification today happens in the market is that treatment, if the assessee wants to do it as stock in trade, he can do that, and the income will be taxable as business income. But if the assessee has to do is inclined to have a treatment of capital gains, then if the holding period is more than 12 months, in case of listed shares, that treatment will be accepted without any litigation. If the holding period for listed is less than 12 months, that can be litigative, and therefore we go back to some of the principles originally given by the CBDT in some of its earlier circulars that will become applicable. If it is unlisted shares, it will be generally capital gains only, unless it is transferred with control and management of the company. So this is how the position can be summarized. Any questions on this so far? So I'll assume that there are no questions. I'll move ahead. Now, this was about the classification of income. Now we talk about specifically that how the capital gains taxation happens. Capital gains arise from transfer of a capital asset. Now, both these words, transfer and capital asset, are important because unless these two ingredients are there, capital gains cannot arise. The definition of the term capital asset is given in section 214, and it includes property of every kind held by an assessee, which is not connected with business. So everything that is there is all capital asset except for business assets, and there are a few other exceptions to this, like personal effects, etc. But by and large, everything is covered under the definition of capital asset. Again, the term transfer is very wide, and it's defined in section 247. Perhaps under the sun, everything what could be considered as shifting title from one person to other person is covering that. So more than not, everything gets covered under the definition of transfer. Then there are certain exceptions. In certain situations, the Act does not want the transfers to be taxable as capital gains, and these are kind of exemption provisions provided, and these are given in section 47. These are more like incentives that even if there is a transfer, there is a capital asset, but still there is no capital gains arising because they fall under the purview of section 47. We all know that capital gains can be short-term or long-term depending upon the period for which they are held. As we are focusing on securities, the period to classify long-term and short-term is as mentioned on the screen at the table below. So listed securities become long-term if they are held for 12 months or more. Unlisted shares become long-term if they are held for 24 months or more. And other securities like debentures, etc., they will become long-term if they are held for 36 months or more. Now, how do we compute capital gains? So from the full value of consideration sale price, we reduce the expenditure incurred wholly and exclusively in connection with the transfer, cost of acquisition, and that's how we get the capital gains. As we discussed earlier, deduction for STT is not allowable while computing capital gains. In case of long-term capital assets, when we are computing capital gains, an indexation benefit is available, and the cost inflation index is notified every year by the CBDT, and for the current financial year, it is 317. My apologies, the financial year should have been 2021 and not really 1920. So 317 is for the financial year 2021. There are certain issues in relation to computation of gains for non-residents, and we'll discuss this as we move ahead on the next slide. Any questions so far? I'll keep asking this because I am unable to see the questions in the chat box. So I'll just keep asking this.
So we have a question. What about the taxation of listed debentures or unlisted debentures and cumulative debentures?
Okay. So we'll come to that. Maybe this will get answered as we move ahead, because we just have spoken about the mechanics, how to compute the capital gains amount, but what specifically happens in case of specific debentures, we'll come to that. Now, when we talk about the listed shares, the scheme of taxation for residents and non-residents is largely similar. Both of them are taxable at the rate of 10%. There is slight caveat in that, and I'll explain that by way of an example on the next slide. As far as unlisted shares are concerned, no indexation benefits are available to non-residents. So second proviso to section 48 is not available to non-residents. And the reason for that is, there to non-residents, the first proviso to section 48 is applicable, and that talks about converting the capital gains or computing the capital gains first in the foreign currency, and then recomputing it into the Indian currency, as in converting that gain into the Indian currency. Now, what happens is that when this particular mechanism is applied, then automatically the inflation adjustment happens because of applicability of the exchange rates. And therefore, there is no separate necessity to have an indexed cost of acquisition. We'll just see this by way of an example. So this is an example, if you can see on the slide. The date of acquisition of the share is 1st Jan 2018, and the cost price is equivalent of US dollars 1,000. That is sold on 20th January 2020, and the USD equivalent on that date is 990. If we actually see in foreign currency terms, there is a loss of $10. And if we convert that applying the rate of 75 that is prevalent on the sale date, there is a loss of 750 rupees, Indian rupees, on this particular transaction. But let's look at it when we do this, when we compute these gains only in INR. And the way it will work out is that the sale consideration on that date, the prevailing price is 75 rupees per dollar, and therefore the sale consideration is 74,250. The purchase price is 65,000 because the exchange rate is 65 on the date of purchase, and the capital gains therefore comes to 9250. And the question therefore arises is that what is the right mechanism to compute the capital gains? Do we compute the loss as given in the first table, or do we compute the gain as given in the second table? Now we are talking in the context of unlisted shares, and in case of unlisted shares, there is a specific section 112(1)(c) that's applicable to non-residents, and that prescribes for a concessional tax rate of 10%. Now, the 10% rate is subject to the condition that there should be no impact of the indexation and currency benefit. And therefore, if we were to compute the gains in INR only, 9250 is the position and not the 750 rupees as a loss. Now, having said that, what typically happens in practical life is that people do the agreements for unlisted shares on a private basis, and in the agreement they have the liberty to put the price in whatever currency they want. They may put it in US dollars, they may put it in INR, whatever they may want, they can do. Now, let's say that if the agreements are executed in a manner that they express the purchase price and sale price only in USD, and therefore we are actually having a situation where we can apply the outcome as given in the first table. So if the cost price is mentioned as $1,000 at the time of acquisition, the sale price is mentioned at $990 at the time of acquisition, there is no rule under the income tax law that kind of mandates me to make the computation as given in the table below. So I can very well actually go for a situation which benefits me. So if let's say that, because of currency fluctuation, I'm at a disadvantageous position, I will actually express everything in Indian currency if that leeway is possible. Alternatively, if currency fluctuation is to my disadvantage, I will express everything in foreign currency because there is no specific mechanism prescribed. All it says is that currency fluctuation should not be taken. So that means that if the price is given in INR, one should not compute it in foreign currency and then recompute into the Indian currency. That's what it would mean. I hope I'm clear on this. If there are any questions, please feel free to ask. Okay. So moving ahead and coming to the point of debentures. Now, debentures, listed debentures, again, if we talk from the resident perspective, that is all Indian rupees only, and the gains will be taxable. From a non-resident perspective, these securities will be taxed at 20% rate, traded on the stock exchange, and currency fluctuation is permitted in this case because first proviso is specifically applicable. They do not make any distinction between a listed or unlisted, unlike 112A, which talks about listed shares, and there the first proviso benefit is not available. This is another example, as I was explaining, that if the agreements are made out in Indian rupees. Now, if we see this particular example, the top table indicates that the cost price and sale price is Indian rupees 1,000 only, though the exchange rate on the purchase date and the sale date are different. So if we look at purely the top table, there is no gain, no loss on purchase of this particular security. But if we were to compute it in the foreign currency, then there is a capital gain of 42 rupees. So depending upon whatever mechanism best serves the parties, they may decide to put the consideration accordingly in the agreement. The tax rates at which the capital gains are subjected to tax. Short-term capital gains are subjected to tax at the normal rates applicable to the investor. For long-term, we have multiplicity of rates. Benefits of indexation is available on long-term capital assets. Of course, this is subject to certain restrictions in terms of listed shares, etc. Taxation of unlisted shares, residents 20% with indexation benefits, non-residents 10% without indexation benefit and foreign exchange fluctuation benefit. This is how the section reads, but as we saw earlier, that if we make our agreements in a manner that we are able to avail the benefit of currency, there is no prohibition of that. One can always do that. Then we talk about taxation of listed equity shares, listed equity oriented mutual fund and units of a business trust, that is a REIT or a InvIT. The tax rate applicable is 10% without indexation and foreign exchange fluctuation benefit, and this is provided under section 112A. Now, this is the next point is very important and interesting. So for listed shares on which STT is not paid, the tax is lower of 10% before availing indexation benefit or 20% after availing indexation benefit. This is because of the proviso given in 112 section, which says that you have to make a comparison without availing indexation benefit and after availing indexation benefit, whatever rate, wherever the tax payable is least, the assessee has an option to choose that rate, particular option. There is a very interesting judgment also on this issue of Kane Energy. So what had happened in that case is that the assessee sold shares of a listed Indian company and had huge amounts of capital gains on that. Now, assessee being a non-resident, they also availed the benefit of currency fluctuation on that. The department challenged that because at the first place, they were applying a tax rate of 10%, and simultaneously, they were also availing the benefit of currency fluctuation, and therefore the gain amount became very less. The matter went to High Court, and the High Court upheld the position of the assessee because what the proviso says is that indexation benefit is not available, which is given in second proviso to section 48, whereas there is no prohibition on application of first proviso to section 48 that talks about the currency fluctuation benefit. So the assessee, being a non-resident, took the benefit of first proviso to section 48 and at the same time availed the benefit of 10% tax rate. On bonds and debentures, there is no indexation benefit available. Of course, there are certain carve-outs given there, but that's very far and few, so we'll not get into that. Any questions again so far?
No, sir. Please continue.
Okay. So again, this is just a summary slide which kind of brings out like sale of shares, listed shares and unlisted shares, business income, then taxable at normal rate, capital gains, then long-term taxable at 10%, short-term taxable at 15% in case of listed shares. For unlisted shares, long-term taxable at the rate of 20%, non-resident 10%, and short-term taxable at the normal rates. So this is the kind of a summary of what we discussed. Of course, there are nitty-gritties given on the earlier slides. Now we move to the specific issues that come because of these provisions. So we spoke about that asset becomes a long-term capital asset if it is held for 12 months or more from the date of its acquisition. Now, what happens if an asset is acquired, let's say on 1st Jan 2020, and it is disposed on 1st Jan 2021? Will it be a short term or will it be a long term? Or rather, the question is that whether both the purchase of date of purchase of asset as well as the date of sale of asset need to be included in the holding period, or should it be only one of the dates? Now, not many judgments are there, but there is one judgment of Delhi High Court in case of Bharti Gupta Ramola that has held that once a 12-month period is complete, that is the 12-month period will be completed for a security acquired on 1st of Jan on 31st December, and therefore if it is sold on 1st of Jan 2021, it will constitute a long-term gain. Now, in our experience with the tax department is not accepting this position, and this is prone to litigation. The other thing is that if this treatment is adopted, then clearly the point to be kept in mind is that if there is any loss, then even that loss should be treated as long-term, and one cannot have both the best of both the worlds as such. So there is a word of caution in following this approach. So please bear that in mind. The next is that in case of dematerialized shares, the gains need to be computed on a first in first out basis because there is no distinctive number available of the shares, and that's where the department has prescribed a first in first out FIFO methodology. Now, because of application of this FIFO methodology in certain situations, some issues arise. So the first is that, when certain shares are offered in an open offer or a buyback offer, company may say that, okay, they want to purchase X number of shares from the market under the buyback offer. And the company has the liberty to choose from each shareholder as to how many shares they want to buy back. They may not buy all the shares those are tendered in the buyback offer. So if a particular person offers 500 shares and the company accepts only 200 shares, the remaining 300 come back to his demat account. In that situation, these 300 go, as such, it went on a FIFO basis, but when it comes back, it comes in the demat account as the last in. So the FIFO methodology goes for a toss. So if those 300 shares are sold later and in between there are few other purchases, then by default, those purchases in between will take precedence over these 300 shares. Similar situation will happen when the shares are lent under securities lending and borrowing scheme. So when the shares are lent under that scheme, they go out from the demat account, and when they are returned by the borrower, again they come and they become the last in the sequence in the demat account. So this leads to some bit of a situation where actually the FIFO is not applied very technically on a consistent basis, but that's how the provisions are. Then, if you will all recall, until 31st of March 2018, long-term capital gains on listed shares were not taxable. They were exempt under Section 1038. With effect from 1st April 2018, these shares have been made taxable. And when this announcement was made of their taxability on 1st of February 2018, it was announced that everybody who holds long-term shares or who will sell any long-term listed shares will get a cost step up, and that cost step up will be the price prevailing in the market on 31st Jan 2018. So let's kind of understand this by way of an example, that what the provisions say. So let's say that the cost of acquisition for shares acquired on 1st of April 2015 is 100, and we are considering 5 scenarios, and in all 5 scenarios, the rate is 100 rupees. The fair market value on 31st Jan 2018, which is the cutoff date to have a higher fair market value if that is in excess of the cost. So in first 3 situations, it is 150 rupees, and in next 2 situations, it is 80 and 50 rupees. Now let's assume that these shares are disposed of, which have become long-term by 30th June 2018. In first situation, they are disposed of for 120 rupees. Now, what the provision says that if the cost on 31st Jan 2018 is more than the cost of acquisition, which is 100 rupees, then that higher amount should be substituted. But in a situation where the sale price is less than that particular fair market value on 31st Jan 2018, then the lower of the FMV on 31st Jan 2018 or the actual sale price, whatever is lower, will be substituted. So in our example, scenario 1, the shares were acquired for 100 rupees. The fair market value on 31st Jan 2018 is 150 rupees. The shares are eventually sold for 120 rupees. So the cost of acquisition will become 120 rupees, and correspondingly, there is no gain in scenario 1. In scenario 2, the fair market value is 150 rupees on 31st Jan 18. Original acquisition price is 100. The shares are eventually sold for 200. Since 150 is more than 100, that substitutes the cost of 100, and the gains that arise are of 50 rupees. And similarly, this working has been done for scenario 3, 4, and 5. So basically, 31st Jan 18 substitution is not just purely the market value of that date, but that needs to be compared with the eventual sale price, and accordingly, the cost of acquisition needs to be worked out. Any questions? Okay. Now, the slide that you see is some typical situations in case of listed shares. Assume a situation that you held shares of a particular listed company before 31st Jan 2018. Let's say the name of the company is A Limited. The price prevailing on 31st Jan 2018 will clearly be a cost step up available eventually when you sell the shares. But before you could sell the shares, A Limited merged into B Limited and you got the shares of B Limited. Now this merger happened after 31st Jan 2018. Now you don't have any cost available for that particular entity of 31st Jan 2018, that is the merged entity. The question arises, how do you do it? So will be the case in case of a demerger, because again, the resultant company was not existing on 31st Jan 2018 and you are now holding shares of that entity. So again, that's an issue. Now, at least in case of a demerger, the proportionate cost of shares, you can always work out that, okay, if the total value of 31st Jan 2018 is say 1500 rupees, and the demerger, that the division that got carved out was 40:60, then clearly the share price of 31st Jan 1 can bifurcate into that 60-40 ratio, that is 900 and 600, and can say that, okay, accordingly the cost is worked out. But in case of an amalgamation, imagine that the entity that you have merged into, or one of the entities that has merged into in this listed entity, is a completely unlisted entity. Then in that case, it's very difficult to work out. Bonus shares, right shares will not pose as much of an issue because in any case, the cost of bonus shares is taken to be nil. If they have been allotted before 31st of Jan 2018, then clearly a cost step up is available. So will be the case with the right shares. So that's not too much of an issue. Again, stock split can create an issue because let's say that the stock was face value of rupees 10 before the date of 31st Jan 2018. After 31st Jan 2018, the stock is split into 10 different shares. So 10 rupee face value share becomes 1 rupee face value. In that case, you will have to just take the 1/10 of the price of prevailing on 31st Jan 2018 because that was reflective of a higher face value. So that's a practical way out, but as such, the law does not prescribe these kind of situations. Any questions on this?
No, sir. Please continue.
The next is about taxability of dividend income that has been made taxable from 1st April 2020. Now, as such, the dividend is taxable for residents at the normal tax rates applicable to them. For non-residents, for various categories, different kinds of tax rates are given. The only point I would want to emphasize on this particular thing is that, super surcharge is applicable to individuals, HUFs, or some of the other non-corporate or form of entities, as a non-firm form of entities. Now, specifically for capital gains income from listed shares, listed equities that are covered by 111A or 112A, and dividend income, the super surcharge does not apply. So in case a person is having income which attracts a surcharge of 25% or 37%, the higher surcharge of this 25% or 37% is not applicable to dividend income or to income which is taxable under section 111A or 112A. The surcharge will apply to dividend and these particular capital gains income at the maximum surcharge rate of 15%. This is interesting from setup of capital loss point of view. So we have seen situations that where we have short-term capital loss of 15%, which is taxable at 15%, 111A loss. And we also had some 30% short-term capital loss, and we adjusted this 15% short-term capital loss against the 30% short-term capital gains. Department was of the view that this particular setup cannot be done, whereas there is no prohibition under the income tax law for doing such a setup. And eventually the matter was held in favor of the assessee, and the appellate authority mentioned that there is no bar and this is doable. This is actually important. So here what happened is that, as we saw, as we spoke earlier, that section 1038 provided exemption for long-term capital gains. Now, let's say that if somebody incurred a loss in a transaction, so that loss would be long-term capital loss, which is exempt. And the question is that whether this loss, which is exempt, is eligible to be carried forward and adjusted against long-term capital gains, which are taxable. Now, one of the cases this happened, and this was allowed actually by the tribunal and according to me, even the High Court. And the reasoning given was that in case of income being exempt, there are conditions prescribed, then income is exempt only upon satisfaction of those conditions. So therefore, if we talk about section 1038, the income is exempt only if the sale happens on a stock exchange and securities transaction tax is paid on that particular sale. So there is a condition prescribed. If this particular condition is not satisfied, section 1038 benefit is not available. So therefore, wherever you need to satisfy the conditions to avail a particular exemption, then loss cannot be treated as if it's exempt source loss. Then in that case, it is the choice of the assessee, because in case of a positive income, the assessee is able to claim an exemption only if he is satisfying the condition. So that cannot be interpreted in a manner that in case of a loss, the assessee, since he has satisfied that condition and therefore he must claim that loss as exempt. No, that cannot be the case. So therefore, they permitted the set off of loss which was from exempt, as in 1038 kind of a loss, and that was allowed to be set off against the long-term capital gains which were taxable. And then these are some specific situations. We'll just quickly run through them. So bonus shares, the cost of acquisition is considered to be nil. The period of holding dates from the date of allotment of such shares. Right shares, the amount that is actually paid for acquiring the right shares is the cost of acquisition, and the period of holding is from the date of allotment. Renunciation of rights, again, that's a capital asset. The cost is nil, and the period is from the date the rights are available till the date when they are sold, and typically these will be short-term only in nature. Stock split. Now here the period remains unchanged and the cost also kind of gets bifurcated on a proportionate basis. Consolidation of shares, the period of holding remains unchanged, and to the extent the multiple shares consolidate to make a one share, all those costs need to be aggregated. There are certain anti-abuse provisions in relation to transactions in securities, and the notable ones are 56.2.10 and 56.2.7b. We'll just quickly run through them. So 56.2.10 talks about, wherever a person acquires any property for no consideration or for a consideration which is less than the fair market value. The word property includes shares as well. When this happens, the income, as in the difference between the fair market value and the actual consideration, is taxable as income of the recipient under the head other sources. A few interesting questions arises that whether this 56.2.10 applies to non-residents, as in can there be any saving grace under the tax treaty provisions? The second is that in case of issue of fresh shares, will 56.2.10 apply? Because typically 56.2.10 is considered to be in the context of property getting transferred from person A to person B. But in a situation when the property is getting generated in the process of being given to a person, that is when fresh shares are being issued, will 56.2.10 apply? Then third is that whether a conversion of debentures or preference shares into any other kind of shares, again in that situation whether 56.2.10 will apply or not. And as far as the first question is concerned, typically people go on a cautious side and they assume that the provisions apply even to non-residents because these are deeming fictions given, and more often than not under the tax treaties, also the other income article, by and large takes you back to the domestic provisions of the law for taxability purposes, and therefore any contrary position taken would be kind of very litigative. As far as fresh issue of shares is concerned, again, the provisions of 56 to 10 apply because they do not talk about the word transfer in the section. In fact, there is one judgment also that is in the context of Sudhir Menon. Now, there the High Court interpreted the matter to mean that in case of right shares, since the rights of the parties are not getting changed because everybody subscribes on a proportionate basis, therefore 56 to 10 should not apply. That was their contention. Their contention was not that on fresh issue of shares pursuant to the right issue, the 56 to 10 does not apply. No, it was not their contention. The only contention when they said 56 to 10 does not apply, because that in that case, it was a case of right shares. As far as the third issue is concerned, when shares are converted for preference shares or debentures, one can argue that the asset that is being surrendered, that is preference shares or debentures, on that particular date would have a value equivalent to the shares that are being issued on that particular date. So let's say that the preference shares or debentures were acquired 5 years earlier, and today they are getting converted into equity shares. Now, if the holder of those preference shares or debentures were to go out in the open market and sell the preference shares or debentures on this particular date, their value will exactly be the same as those of the equity shares being allotted in lieu of those preference shares or debentures. So therefore, there is no under consideration in that case. Now, as far as the fair market value is concerned, that is to be worked out in accordance with the Rule 11U and UA. This we have already covered, when we're talking about the issues on the previous slide. Now, this is 56 to 7B. This is from the perspective of the company issuing the shares. Now, a company, when it issues fresh shares, that company also cannot issue shares at a price which is less than fair market value. And if it does at a price which is less than fair market value, then to that extent, it becomes an income of the company. This is popularly also called as the angel tax, because this is quite prevalent in the context of some of the technology companies wherein they issue shares at a particular price which may not be reflective of what their business plans might be for 5 years or 7 years. And they typically do it because there is a lot of uncertainty whether the idea they are trying to come up with or build a technology around whether will be successful or not. And you might have read articles in the newspapers that angel tax was a big issue, and eventually some corrective measures were also taken. But still, this provision exists. It doesn't apply to those new age companies which are registered with the Department of Information and Technology, but it certainly applies to other companies. Again, the fair market value for this particular section is to be ascertained in accordance with Rule 11U and UA of the income tax rules. Conversion of debentures or preference shares into shares. Now, is that a taxable event? Conversion of debentures into shares was always clear that it is not a taxable event. It's an exchange. It's not a taxable event. In case of preference shares, there was no explicit provision under Section 47 originally, but about 3-4 years back, that lacuna has been filled, and now there is a specific provision. So now that provides for that conversion of preference shares into any other class of securities, again, is not a taxable transfer, and therefore no capital gains tax arise on that date. Now, eventually, when these converted shares, as in the shares received on conversion of debentures or preference shares, are sold, the period for which the debentures or preference shares were held will also be included to ascertain the long-term, short-term nature of the share, as also the cost base will be the same for which debentures or preference shares were acquired. With this, we now move on to the debt instruments. Any specific questions so far on equity related instruments? Okay. So in debt instruments, I mean, these can be the various debt instruments, that is corporate debt securities, government bonds, treasury bills, commercial papers, zero coupon bonds, deep discount bonds. What we will do is that we'll bifurcate these into two sets of debt instruments, one which have coupon and other which are non-coupon bearing, that is they are issued at a discount to the face value and are redeemed at face value on the date of maturity. So how the taxation treatment will differ in the two cases. We'll skip for the time being the zero coupon bonds because that's not too much prevalent in the market. We'll straight away go to this examples here. So situation one is a situation where the debt security is issued at a price of 50 rupees and the face value is 100 rupees. So eventually the person holding it will get 100 rupees on the date of maturity and has incurred initially 50 rupees. So 50 rupees is the margin that he gets by holding the security over the period of that security. The second situation is that when the person is buying it from the open market, the face value is 100, but he is selling it at 90 rupees before the maturity date, and he is buying it at 70 rupees from the market, though the issue price is 50 rupees. And the third situation is that he is buying it from the market but holding it to maturity, that is buying for 70 rupees but redeeming or getting redeemed eventually at 100 rupees. Now let's look at some of the issues that will come here. Now when a person is subscribing to the security at 50 rupees and holding it till maturity, isn't redemption a transfer of securities, because extinguishment of the right or the security being given back to the issuer, and therefore can we say that this 50 rupees difference between 100 minus 50, this 50 rupees is not interest but it is a capital gains, because somebody acquired a security, held it for certain duration and eventually got it redeemed for 50 rupees, and therefore to that extent it is a capital gains income that gives a concessional rate compared to a interest income that will be taxable at the normal rates. Convincing proposition, but very difficult to kind of argue before the tax authorities, because typically if we look at it from the perspective of time value of money, the person invested 50 rupees initially, got 100 rupees, which was the difference in the time value of money, and therefore this is nothing but interest. That's what the department is going to say that. And highly litigated position, so very difficult proposition that it is purely capital gains. And that's how even the market practice also is. In fact, to some extent, reference can also be made to the circular issued by CBDT in relation to deep discount bonds, wherein the CBDT very specifically has mentioned that in case of deep discount bonds, at the end of every financial year, that is on 31st March, the holder of the security will have to offer the interest income to tax, considering the fair market value of that security prevalent as on 31st March of each year. So CBDT clearly prescribes that, in case of deep discount bonds, the income accrues on an annual basis and needs to be offered to tax as interest income. That principle should apply in this case also, and therefore it will be very difficult to kind of go with the presumption that everything is capital gains. The second situation is about when the security is bought at 70 rupees and sold at 90 rupees. Now, clearly, when it is bought and sold, then in that case, the characterization of income will depend upon whether the security is held as capital asset or business asset. So this 20 rupees differential, what the investor may get, could be capital gains or could be business income. But the situation that arises is that let's say that in between so there is no question of any interest arising in between. So clearly this will just be a kind of capital gains or business income, and depending upon the profile of the investor, that investor will have to pay tax on that. But let's say that in between a 31st March event arises, what the investor should be doing? Should it be offering interest income to tax? And to that extent, should the cost of 70 rupees be further increased? Because the date on which the security was acquired, 70 rupees would actually include the broken period interest. So what happens, let's say that, this was acquired exactly on 1st of October, that is 6 months, before the end of the financial year. Now for 6 months, should interest income be considered by the investor who holds it on 31st of March after acquiring it for 6 months? Or should it just kind of not accrue that? Again, not a very straightforward answer. Considering the CBDT circular on deep discount bonds, the investor should offer that income to tax and correspondingly increase the cost base. That is, the 70 rupees would actually increase by the amount of interest. And eventually, when it is sold for 90, only the differential amount should be capital gains or business income. We talk about situation 3 when it is kind of bought for 70 and redeemed at 100. This is very specific situation because in this case, the holder of instrument will get 100 rupees on maturity. He has already paid 70 rupees to the seller of the security. Now, as such, there is a possibility that the issuer might do a TDS on entire rupees 50, which is the difference between the issue price and the face value. But from a holder perspective, his income is only rupees 30. The first thing is that, is it interest or is it capital gains? I think we have already discussed it as part of situation 1. The second is that if this 50 rupees is reflected in 26 years, the TDS might reflect on this entire 50 rupees. And the question will arise is that what happens to this 20 rupees? Should this be claimed as an expense or should the interest income be offered to tax as 30 rupees only? Again, no straightforward answer to that, but either of the practices may be followed. At the end of the day, nobody is supposed to pay tax on an income which is not real. So from that perspective, either a deduction for 20 rupees should be available, or it should be assumed that the cost base is 70 rupees and therefore his net interest income is only 30 rupees. This we have already discussed. I'll just move on to this one particular section, section 194 LD. We talk a lot about these in normal course. This is about, interest income arising to foreign portfolio investors on debt securities acquired by them. This section provides for a very concessional tax rate of 5%. So FPIs are eligible for a concessional tax rate of 5% if they acquire securities, that is corporate bonds, and if those corporate bonds satisfy certain conditions. So what is the condition? The condition is the rate of interest on such bonds should not be in excess of SBI base rate plus 500 basis points on the date of issue of bonds. So let's say that a company is issuing bonds on say today, 27th of June 2021. Today, the SBI base rate is 7.5%. So 500 basis points on that will make it 12.5%. So if the interest rate on such bonds is 12.5% or less, then in that case, the FPI will be eligible for a concessional tax rate of 5%. Now, certain issues arise, it's not that straightforward to work out the rate of interest, because many a times it may so happen that a company may issue a security wherein the rate of interest on an ongoing basis is less than 12.5%. Let's say it is 12%. But at the end of the security, as in on the redemption date, the security also carries a redemption premium, which is like 2% per annum. So let's say that security tenure is 3 years, so it becomes 6%. Even the company accrues this 2% on an annual basis. So should we look at the yield of 14% per annum, or should we look at the 12% rate of the coupon rate of interest that's there on the security to decide whether 5% rate is available or not? Then what happens is that we are having these difficult times of COVID. Many a times the companies go back to the lenders, that is the FPIs, renegotiate with them the rate of interest. So the 12% bond eventually becomes a 14.5% bond. Now, what do we do in that situation? Because the security was issued some 3 years back, we already started availing 5% concessional tax rate for that. Now, all of a sudden for the balance period, because of certain defaults, the rate has been renegotiated at 14.5%. Should we continue to give 5%? Should we withdraw the earlier 5% regime? No straightforward answers to that again. The third is that at the upfront on the date of issue of securities only, it is known that, okay, the coupon rate of interest is 12% on the security. But in the event of a default interest of 4% per annum is payable. What do we do with this default interest? Do we include it? Do we consider that the rate of interest on that security is 16%, or do we still take it as 12%? Again, these are very difficult questions to answer, and much depends upon the profile of the parties, whether they want to take an aggressive stand or a very conservative stand. So this kind of brings me to the end of some of the routine stuff that we see in the market. Now we can move on to the REIT, InvIT, and AIF related issues. But before that, any questions so far?
No, sir, we have not received any questions yet.
Perfect. Okay. So moving on to the REIT InvIT taxation, this has been prescribed for last 5-6 years by the tax authorities, and every year there are some kind of changes they keep bringing about to align it with the requests or lobbying from the investor side. Before we move on to the taxation side, let's look at what is a typical REIT or an InvIT structure is. So here the REIT and the InvIT is, if you can see in the diagram, is denoted by a triangle which is in the between in the middle of the slide. Then there are investors, there is a sponsor, there is an investment manager, and then there are lenders and trustees. So typically what happens, let's say that a particular group, say Raheja group, it has a lot of immovable properties. They want to monetize on their immovable properties, and they want to put all their immovable properties into a REIT, right? So what they will do is that, and what is the benefit of putting them in REIT is that they can get money from third-party investors also. So there is a unlocking of the funds, and whatever amounts they have invested in property, they will be in a position to actually get their money back, and therefore they do the REIT structure. So what they do is that, one, they can put their immovable property in the REIT, and in exchange for that get units of the REIT. The second is that if they hold the properties through SPVs, they can exchange the shares of the SPVs for units of REIT. The third is that above those SPVs, if they have a holding company, they can exchange the shares of the holding company and get units of the REIT. So if you see at the bottom left side, you can see all three of these possibilities. That is where the REIT holds the shares of the holdco. The holdco holds the shares of the SPV, and the SPV holds the immovable property. The second structure where the SPV, or rather the REIT holds the shares of the SPV and SPV holds the immovable property. And the third situation where the REIT directly holds the immovable property. The sponsor in this case is Raheja. And then there are third-party investors who come into the REIT. Now, investment manager and trustees will be just to manage the assets that the REIT holds. Now, under the tax law, a complete pass-through status has been prescribed for REITs and InvITs. We'll go to that pass-through structure a little later, but before that, we discuss the initial transfers that happen from the sponsor to the REIT. That is, whatever assets the sponsor holds, which it wants to transfer to the REIT, whether as a holdco or as a shares of SPV or directly the physical assets, and in exchange acquires the units of the REIT. What is the tax implication at that stage? So, when the sponsor transfers the SPV shares to business trust in exchange for units of the REIT, then there is no capital gains tax, because this is one of the exceptions carved out under section 47. And any exchange of SPV shares for REIT units is not taxable at that stage. It is taxable only when those REIT units are eventually transferred. Now, let's say that the sponsor doesn't have SPV, or it doesn't want to transfer the shares of the SPV to InvIT, but wants to transfer the physical assets. So the sponsor gives away its physical assets to REIT and acquires the units of REIT in exchange. Now, this is not an exempt transfer. In this case, the tax gets triggered very upfront only. The third is a situation where there is no exchange, but rather the sponsor transfers it for cash consideration, whether those are shares of SPV or that is the physical property. In that case, also it is a taxable transfer. Many a times, in fact, in few transactions, we have seen that the sponsors transferring the assets partly for cash consideration and partly for units. There also, it's not a very clear situation, and the likely view is that it is taxable, because under the law, it is only when a complete exchange transaction is there, then only it is a not a taxable transfer. And the last point is that in all these situations, if you see, the REIT must hold minimum 51% shares in the SPV. Now, this is something that's a condition prescribed by SEBI, so it's a regulatory condition. So what happens is that the sponsor will have to give away control to the extent of minimum 51%, and that will trigger section 79. And because of that, all the losses, if the SPVs have any losses, all those losses will lapse. Now, this is all about the initial transfer of assets to REIT. Now we talk about the ongoing income streams that the REIT and InvIT will have, and how the REIT, InvIT, and how the investors are taxed. So typically, if we go back to the structure once to see what will be the kind of incomes that a REIT, InvIT will have. So if it is a REIT, then in the first situation, it will have rental income where it is holding the property directly. Where it is holding the property through SPV or through a holdco structure, then REIT will receive income by way of dividends or interest. Similarly, in case of an InvIT, if the InvIT holds the assets directly, now let's say that it holds a toll plaza. So because of operating the toll plaza, the income that the InvIT will receive will be of business nature. That is, it will have the toll collections, it will have the expenses, etc. So that will be a business character income. If it is holding these assets, toll plazas, etc., through other assets through a SPV, then in that case, again, the InvIT will have income by way of interest income or by way of dividend income. So going back to the slide here. So if it is an interest income received by REIT, InvIT from the SPV, there is a particular specific exemption given that the SPV need not withhold any tax or deduct any tax from the payments of interest to the REIT or InvIT. The REIT, InvIT is a complete pass-through entity as far as the interest and dividend income is concerned, and the income is taxable directly in the hands of the investors. So there is no tax at REIT, InvIT level. In fact, the SPV that pays the interest, it gets the deduction for the interest expenditure. There is no withholding tax at the SPV level. There is no tax leakage at the REIT, InvIT level. Yes, the REIT will have, or the InvIT will have to do a tax withholding when they are making payment of that interest income to the investors. Now, withholding tax on distributions to residents is 10%, and for non-residents, it is 5%, because the tax rate for taxability of interest income in the hands of non-resident unit holders is 5%. So a 5% tax rate is applicable in case of interest income paid by REIT to investors. A complete pass-through is status given, REIT, InvIT not being taxable. Dividend also happens on a similar basis. That's also a complete pass-through status. So no withholding tax to be deducted by the SPV. REIT, InvIT exempt in their hands, and the investor will have to pay tax on that. For resident investors, the dividend income will be taxable at the normal tax rates. For non-resident investors, the income will be taxable at 20% rate. There's a slight catch in this dividend here, because until 31st March 2020, the dividends were exempt for the recipient shareholders because of DDT applicable in the hands of the company distributor declaring the dividends. Now, there was a particular subsection in section 115O, which said that any dividends payable to a REIT InvIT, there will be no dividend distribution tax on that. So the company is declaring dividends to REIT InvITs. There was no requirement for paying DDT on that. With dividends becoming taxable in the hands of the shareholders, then clearly that particular benefit went away. In fact, now the investors are required to pay tax on that. The only condition in which investors need not pay any tax on this dividend income is that when the SPVs, which are declaring the dividends, or the companies which are declaring the dividends to REIT, they have not opted for the concessional rate of tax of 25%. So if they have opted for concessional rate of tax of 25%, dividends are taxable for unit holders. If they have not opted for the concessional rate of 25%, dividends are exempt for the unit holders. So this is about the interest and dividend taxability. Then one more stream of income that is a complete pass-through from REIT to investors is rental income. So it's not the rental income derived by SPV, because once the SPV derives rental income, it can upstream only by way of interest or dividend. So when the REIT is holding the asset directly and it is deriving interest income, then that rental income. So that rental income, when it is upstream to the investor, it is taxable directly in the hands of the unit holders investors. It is not taxable at REIT level. So that is the third income where a complete pass-through status is given. This income is taxable for the unit holders at the tax rates applicable to them. So for resident investors, the normal tax rates. For non-resident investors, again, it is income from immovable property in India. So routine normal tax rates, depending upon the stature of the investor, will apply. Barring these three incomes, that is rental income, interest income, or dividend income, REIT is not a pass-through, and the tax will have to be paid by REIT or InvIT at that level. And correspondingly, when this income is upstreamed further, that income is exempt for the unit holders. So either the income is taxable at the REIT or InvIT level, or it is taxable at the unit holder level, but it is not taxable at both the levels. Any questions on this?
Yes, sir. Shikhaji is asking, debt instrument mutual funds also taxable in same manner?
Same manner would mean what? I'm so sorry. What?
Sir, actually,
okay, no problem. So what we can do is that we can park this question for the last, and we'll take it then at that stage.
Okay, no problem.
Moving on to the securitization, this is the structure that's normally followed. That's perhaps the only structure. So what happens is that, banks normally give out, or NBFCs give out loans to borrowers. Now, either the NBFC or the bank may decide to sell the loan to a trust, and that trust is called as the securitization trust. So the trust will buy out those loans and hold those loans for the investors. So the trust will raise money from the investors to buy out the loans, and therefore the loans will get assigned from banks or NBFCs to the trust, which will then hold the loans. And to purchase those loans, the trust will issue securities to the investors. Those securities are typically called as PTCs, pass-through certificates, or security receipts, SRs. So that is how the structure is. So basically the relationship between the bank and the borrower normally ends. The trust acquires the assets of the banks and they sit on the books of the trust. And trust does this by raising monies from the investors. And thereafter, either the trust keeps recovering money from the borrower, on its own or in the normal course of business, or if it is a case of a bad asset, Then ARCs also come in picture, wherein they play the role of a reconstruction company. So they do the negotiations with the borrower to recast the loan or redefine the rights and obligations between the loan they have acquired from the bank, such that they are able to maximize the recovery, and therefore they also make money and the investors also make money. So this is how typically the structure works. In the past, there were a lot of tax issues around this particular structure, because the department used to say that the trust, the investors and the ARCs and all these are working as a AOP, association of persons who have come together for a common purpose, and therefore the department will levy tax at the trust level, whereas the contention of the all the parties to this scheme would be that trust is a complete pass-through. Whatever income has come should be directly taxable in the hands of the investors and not at the trust level. And the reason being that, if it gets taxed at trust level, MMR will apply, and there will be no deduction for expenses which each investor might be incurring at his end against that income. So that used to be a very tax inefficient way when the income was getting taxed at trust level. Huge rounds of litigation happened in that, and then a lot of representations were made to the ministry, and eventually in 2016 they prescribed a particular treatment whereby they provided a complete pass-through status to the trust. So what happened is they said that income will be taxable directly in the hands of the investors as if the investment has been made directly by them. So a complete pass-through status given. The securitization trusts, that is, these trusts are completely exempt from tax because income is now directly taxable in the hands of the investors. When the borrowers make payments of amounts to trust, say towards interest, typically it will be towards interest, there is no requirement for the borrowers to withhold any tax under 194A or 193, any of the sections. They don't need to withhold any tax. When the trust will pay tax, when the trust will pay money to the investors, they will do a tax withholding as per section 194 LBC. So this is how the scheme works. It is a complete pass-through kind of a status given to securitization trusts. Having said this, I mean, on the face of it, it will look very, very simple that, now there are no issues, but still issues remain. Let me give you an example. So let's say that, it's a case of a bad loan, and the bank has given a funding of 100 crores to a particular borrower. The accrued interest on that is 30 crores. Total amount due to bank is 130 crores. The ARC, Asset Reconstruction Company, buys out this particular 130 crore outstanding by paying 45 crores. So, quite at a discount to what was payable to bank. Now, 45 crores is what ARC has invested. It has discussions with the borrower and negotiates and says that, okay, you owe the bank 130 crores, forget that 130 crores, we recast your loan at 80 crores plus interest, and a rate of interest which is concessional to what banks were charging. So you pay us 80 crores plus that concessional rate of interest. Now the borrower pays 2 installments, and after that again it is not in a position to pay. Now what happens? Do we recognize interest income on an ongoing basis? Because if we do that, the investors are required to pay tax on that interest income. And if we do not do that, then do we have the liberty or leeway to actually not recognize that income as and when it is paid by the borrower? And the argument for not recognizing that income would be that these are bad loans. There is quite a lot of uncertainty with regard to their recoverability. So unless the amount of 45 crores that has been invested in acquiring these loans, unless that entire amount is received, there should be no income considered. So everything that the borrower pays should first be attributed towards the principal amount of 45 crores, and balance recovery, anything above 45 crores should only partake the character of income. So is that view possible? That's point number one. Point number two is that in case of investors, there are a lot of non-resident investors also who participate in this. Now, typically, they would prefer to be governed by the provisions of the act or the tax treaty, whichever is more beneficial to them. Under the tax treaty, what will be the nature of this income? Because let's say that the borrower is paying interest. What the investor is getting is a return on the security receipt held by him in a securitization trust. And by holding that security receipt, there is no borrower-lender relationship getting created between the trust and that investor. So can this amount really be called as interest? And therefore, if any concessional tax rate is prescribed for interest income under the treaty, can the investor avail of the benefit of that particular concessional tax rate? So these are some challenges that keep arising in these kind of transactions. I'm just laying down these issues because in the interest of time, we cannot discuss all of them at length, but these are some of the issues that keep arising. The next is about the alternative investment funds. This is similar to what we spoke about, as a transparent structure being there as far as securitization trusts are concerned. So similarly here also, it is a transparent status given to the AIFs who invest into the debt and equity instruments of investee companies, and they do that by raising money from investors. So you see investors at the top, the AIF raising money from them and then investing into the investee companies. Now here the characterization of income is very, very important in case of AIF, because if it is business income, AIF is not a transparent entity and business income gets taxed in the hands of AIF only at MMR. Excuse me. But if it is not business income, let's say it is capital gains, other sources, then in that case, it is a transparent entity and the income is directly taxable in the hands of the investors. So that is where the characterization of income is critical. Again, to make the life easy, CBDT has issued circular whereby it has said that income earned by AIF 1 and 2 from the securities held by them will not be a business income, unlisted shares, etc. So it's kind of a clear position. The position is not so clear as far as category 3 AIFs are concerned. Typically, AIFs are classified as category 1, 2, and 3, and 3 are the ones wherein kind of a stepmotherly tax treatment has been given. For the reason that they are more like hedge funds and they deploy very risky strategies to make money for their investors, and somewhere that's not something to which the tax department wants to provide certainty or concessional regime. So in case of category 3, there is no specific tax regime provided under the income tax law. They will have to be treated as a normal trust under the provisions of section 160 to 166 of the Income Tax Act. And depending upon whether the trust is a revocable or a irrevocable trust or a determinate or an indeterminate trust, the tax consequences follow for these kind of trusts. So here again, the characterization of income is critical because under section 161(1)(a), business income of a trust is taxable at maximum marginal rate. So if it is a business income, then at MMR taxable for the trust. Consequently, the income will not be taxed in the hands of the investor. But if we take the argument that income is not of the nature of business, then in that case, if the trust is an irrevocable and determinate trust, that is where the shares of the contributories are known on the date of creation of the trust deed and their names are mentioned in the trust deed, then in that case, the trust is a transparent entity and the income flows through to the investors and those investors only pay tax on that. Compare it to a situation where the trust is an irrevocable trust, but it is not determinate, it is indeterminate. In that case, the income characterization at AIF level is immaterial. Even if it is non-business income, the past status of the trust is lost and the entire income is taxable at the AIF level only. So for category 3 AIFs, it is very, very critical to have the documentation and the conduct appropriately done so that they do not lose out on these tax issues, because effectively AIF being and normally AIFs are set up as a trust, and if they being non-corporates or non-firms, the tax rate, in spite of being 30%, the super rich surcharge will apply to them of 37% or 25% as the case may be, and their tax rate might be in the range of 42 to 43%, which is quite significant. So a lot of so to say diligence is required while drafting documents of these particular trusts. The second important point is that when in case of category 1 and 2 trusts, that is AIFs, when the investee companies, when they make payment of interest or dividend to the AIF, there is no TDS required. Again, there is a blanket exemption given to under the provisions of the under TDS provisions, that whenever amounts are paid to AIFs, there is no requirement to do the TDS, provided they are category 1 and 2 AIFs. And the AIF in turn does the tax withholding when it is upstreaming that income to the investors. In case of AIF 3, there is no such exemption from withholding provisions to investee companies, and therefore tax will have to be deducted when the investee companies make any payment of income to AIFs. And then further, AIFs will have to do further withholding of tax if the income is taxable for the unit holders, depending upon whether the income is taxable or not. Now we talk about briefly cryptocurrency, and here, let's first start with what's happening in the market. So cryptocurrency is a digital currency, of course, not kind of backed by any government of any particular country. Some governments have permitted transactions in cryptocurrencies, but most of the governments are hesitant about that. RBI has always been cautioning investors in terms of investment into cryptocurrencies, and in 2018, they issued a circular whereby they advised banks not to facilitate or support trades in cryptocurrencies. And that is where banks started shunning people, and they were not, I don't have any practical insight, but how the cryptocurrency market developed in India, as of now, I believe there are a lot of investment already there in cryptocurrencies, but when banks were not authorized to do or facilitate trades in cryptocurrencies, how that happened, I'm not very clear on that, but be that as it may, that particular instruction of RBI got struck away by Supreme Court in 2020, and the Supreme Court said that RBI cannot issue such directions. So RBI has issued a fresh instructions to the banks that nobody should cite the 2018 circular of RBI, but at the same time has cast a lot of obligation on the banks to do their due diligence before they can facilitate trades in cryptocurrencies. That is, they have to ensure that the trades are compliant from a FEMA perspective, trades are compliant from a KYC perspective, and various other rules and regulations that may apply to that. With this kind of obligation being cast upon the bankers, again, they are not very supportive of facilitating trades in cryptocurrencies, and that's where you keep reading in the newspapers that XYZ Bank has decided to not support the trades in cryptocurrencies for the time being and all that stuff. So still there is some bit of a reluctance on the side of the banks to facilitate that. And what is the reason why they don't want to do it? Because as I mentioned earlier, that this currency is not supported by anywhere in the governments, normally by the governments of the various countries, and therefore that kind of provides a avenue to launder the money by indulging into crypto trades or for acquiring substances or material which are otherwise not doable. Because today, if I go and buy crypto on a particular exchange, for what purpose I'm using it, nobody is controlling that. And to that extent, it becomes a very, very so to say, not so transparent practice in the market when these cryptos are being used for some prohibited purposes, and therefore the reluctance on the part of the governments. Now, from a taxation perspective, it does not create too much of an issue because even if it's an illegal business, if we were to construe that, the profits or income from illegal business is also taxable. We all know that. So the simple proposition from a taxation perspective would be that if you are dealing in cryptocurrencies, then any buying and selling into cryptocurrencies would be taxable, again, depending upon whether you hold them for business purposes or as capital assets. To classify long-term, short-term, the period of holding will have to be 36 months. And if it is held for more than 36 months, then it should be long-term. If it is held for less than 36 months, then short-term. Clearly, business income taxable at routine rates. One more aspect on taxation side would be that, cryptos can be acquired in the open market, but at the same time, if there are, tech wizards who can actually mine these cryptos, as in there is a possibility that people have those abilities by usage of algorithms or softwares, whereby they can mine these cryptos without spending any money. So therefore, in such a situation, when they're mining these cryptos and having it to their credit, in that case, can an argument be taken that when these cryptos are being sold, then there is no capital gains tax on that, because BC Srinivasa Shetty should apply that there is no cost of acquisition for these cryptos, and consequently, there should be no taxation involved in that case. But this is a very aggressive argument, and so to say untested, because all these things as we speak are happening in the market. There are no precedents on that. So the advice for the time being would be that yes, all these incomes are taxable, and especially if a person who is mining cryptos, in that case, all the more reason to treat it as business income, because that person is engaged in the business of mining it, and therefore to that extent should be taxable as business income. So with this, I come to an end of my presentation. Thank you very much for your patient hearing, and I'll be happy to answer the questions that you may have. We still have half an hour. Maybe we can cover some topics in greater detail if required.
Sheetal madam.
Yes, sir.
We have very short.
Yes, sir. Yes, sir. We have 3 queries. So Shikha madam is asking, debt instruments, mutual funds also taxable in same manner like corporate issued debt instrument?
Yes. So, okay, now if you are talking from an ongoing income perspective, the debt mutual funds will also, give you income by way of dividend. So that will be a dividend income. If you are transferring those investments after a period of 3 years, that will be capital gains. And if it is an eventual redemption, again, that will be a capital gain situation. So I hope that answers your question.
Yes, sir. One question.
I'm sorry. I'm sorry,
Case
madam.
of
Sorry to pause you, madam, but I'm not able to hear you clearly.
Income from InvIT, standard deduction available.
The question is, can we take indexation benefit in case of listed securities? Listed debentures, I'm sorry. Pardon.
No, we cannot. the third proviso to section 48 specifically prohibits indexation benefits for debentures.
That's it. That's it, sir. The queries are over on this part.
Okay, I was unable to hear the madam what she was saying in between, Ritu madam,
I
because
guess she
her
was
voice.
just reading out the question only, which
Okay.
I read in the end.
Sure. So then, since we still have time, if the audience is interested in running through any
Yes,
section,
sir. Yes, sir. We definitely have time. We have half an hour. That's okay with us.
Sure. So let me just.
Sir, can you hear me now?
Yeah, I can hear you now. So should I choose according to me, or is there any preference from the participant side that which particular section I should dwell upon more?
Members may just post their preference if they want. Otherwise, sir, you may proceed as you want.
Okay.
As you feel. So in case of rental income, we have a question. In case of rental income from InvIT, standard deduction is available?
Yeah. So house property income, the way we compute that, those provisions will apply, and that will be applicable directly in the case of the unit holder. The rental income will apply only in case of REIT, not in case of InvIT generally. InvITs are not who lease out the properties, they do the actual business of toll collections, etc. In case of REIT, yes, the rental income will be on a pass-through basis, directly taxable for unit holders. And since this being an income from immovable property, the house property section or the head of income will apply and the standard deduction will be available. So should we move on to the AIF? There are a few issues that I had originally kept.
Yes,
right?
sir, please.
Sure. So, one of the things in case of category 1 and 2 AIFs is that, normally there is a complete pass-through given, except for in case of business income. So we had this practical issue where the AIF had invested in some debt securities. Now, debt securities would generate interest income, and the interest income would be taxable on a pass-through basis in the hands of the investors. Now, interest income, if it is not a business income, then we are talking about its taxability under the head other sources. Now, what happens is that in case of other sources income, the kind of deduction available for expenses is very limited. Because under section 37, if it's a business income, you can claim everything and anything as deduction which is relatable to business. Whereas in case of section 57 that provides deduction for expenses against other sources income, the amount has to be wholly and exclusively spent in relation to that particular earning of interest in relation to that particular source of income. So it cannot be just anything and everything which is related to business, but it has to be necessarily in relation to that particular income. So if you are earning interest income, then only expenses pertaining to which are attributable to earning of interest income will be deductible. So let's say example that AIF incurs audit fees. Will that be attributed to earning of interest income? A dicey position, and therefore the question is that whether you give deduction for these expenses or whether the investors can claim a deduction for these kind of expenses is a challenge. The second is that, in these COVID times, there have been defaults by companies. So when the securities are held by AIF, the interest income arising on those securities was accrued for the AIF, and eventually that was not realized. Now, typically when it is a business income situation, if anything is written off which was originally offered to tax as income, deduction for the same is available. In section 57, no such provision is available, and therefore once you lose out, as in you are not able to recover that, you might have paid tax on that when that income accrued. There is a very little possibility of you being able to claim a deduction of a write-off subsequently. So this is some typical issues that arise in case of EIF taxation. The third that kind of comes to my mind when we talk about other sources income is that dividend income. Now again, the deduction for expenses is restricted only to 20% of the dividend income towards interest. So even though an investor might have borrowed a huge amount of money to put in the shares or maybe into the units of the EIF that is generating him the dividend income, at the end of the day, what deduction he is permitted is only up to 20% of the dividend income and not more than that. So here is a typical case where investors will lose out significantly. Now, in case of REITs in which we discussed about the income tax provisions, but one of the important aspects to be considered before any REIT in which proposition is thought about is the stamp duty implication, because eventually we are talking about shares being moved from one person to REIT or InvIT, or immovable properties from moving from one person to the REIT InvIT. Then there are significant stamp duty implications, and they happen to be quite a lot of dampener in the whole process. So that's another point to be kept in mind as far as REIT InvITs are concerned. I think here I'll just dwell a little bit more on this particular long-term capital loss, which is from an exempt source, and adjustment of that loss with long-term capital gains, which is taxable. So there was a particular judgment of Mumbai Tribunal, and which was later affirmed by the High Court. And the assessee did that, and eventually when the AO proposed to negate this particular set off, the assessee paid tax on that. The matter went in appeal because of the penalty that was levied by the AO on this particular matter, and that's where this matter was heard by the ICAI and High Court, and they deleted the penalty, saying that what assessee did was not wrong, because if you have certain conditions to be satisfied for availing an exemption, that does not mean that loss from that source also becomes exempt, because then that loss is at the choice of the assessee to be not treated as an exempt source loss. And to that extent, the assessee has the liberty to adjust it against taxable capital gains, and that will be in line with the provisions of the Income Tax Act. And the reason they said that 1038 requires satisfaction of conditions, because at that time that required the sale to be executed on the floor of the exchange, and STT should have been paid on the sale transaction. So these were the conditions pursuant to which the exemption was granted, and therefore the ITAT held the way we just discussed. Again, I'll just spend a few minutes on this particular slide. So this is like, we'll take some few practical examples. So let's say that a non-resident has acquired shares of an Indian company. And since we are talking about unlisted shares, then clearly those unlisted shares will be acquired on a private basis, and the agreement will be executed between the parties. Now that agreement will be executed in, say it can be executed in INR also, or it can be executed in USD also. And the typical way to do it is that, let's say that it's executed in USD. Then in that case, if you really want it to be executed in INR, you can say that INR equivalent of this much USD, right? Or USD equivalent of this much INR. So to that extent, you have the leeway to tweak the language in the agreement. Now, what is the benefit of this is that, if you were to see this example here, as we discussed, there is a loss if we just compute it in USD to USD terms of $10, whereas if we do it in INR terms, there is a gain of 9,250 rupees. So with no dynamics changing of the underlying transaction, just by expressing the currencies the way we want in the agreement, we are able to have a tax outcome that is beneficial to us. So this is something that's kind of popular. Of course, in case of very big transactions, it will be advisable to see the pros and cons of everything, and maybe the tax advisors on the other side of the transaction, and a lot depends on the negotiations. But wherever possible, one can take benefit of this particular thing by having the agreement made in a manner that kind of supports the tax outcome you want to have. This is again worth spending few minutes about, when do you kind of say that it has become a capital gain or a business income? Because very frequently in the normal course of things that we have seen, I was having discussions with a fund manager, and he was very, very aggressive, emphasizing that, even if a stock is held for a month, that should be capital gains. And his perspective was that, if a particular trader is trading in the market listed securities, and to say that in a month's time, if he's selling its business income, he says it's impossible that one can have a view of the market for 1 month, because there will be a lot of things that may happen in 1 month, which may kind of make him either to reverse his trade or may actually kind of take more positions of what he has done originally. So he said a trader will never hold a stock in trade just for the sake of holding it for 30 days. If a person is holding a particular stock or kind of a security or investment for a certain duration more than a month, then automatically that's reflective of a capital gains position, investment position, and not really a so to say a business income or a stock in trade kind of a position, because nobody can have a view in the market which is beyond a month. But that was just his view. We all know that in the from a CPTD perspective, the position for up to 12 months is not very clear, and that will have to be kind of seen in light of the circular CBDT has issued. And especially these points become very, very relevant in this COVID time, because last year when the whole lockdown thing started, the Sensex went down from almost 47,000 to 33,000, and there was a lot of selling. They were selling in the stocks which were barely held for a month, and the positions when we were analyzing at the year end on March 2021, the issue was that should they be considered as business income or as capital gains income, business loss or capital gains loss. And more importantly, it may be a beneficial position to avail a business loss situation, but you have to look at it from a long-term perspective, because you cannot change that position every now and then, because if that's kind of giving you a loss in that year and you are neutral whether it's a capital loss or a business loss, doesn't mean that you kind of avail that position, because that will have a bearing in subsequent years as well. So basically, whatever decision you take should have to be seen in light of long-term implications of that decision. And many a times, as I said, this is driven by the market because of these uncertain times. So we saw a lot of funds having a lot of trades during in the first 6 months of 2020 because of COVID. Are there any further questions in the chat box?
No, sir.
Okay, I think that is all from my side. If there are any specific points, I'm happy to discuss, or else over to you.
Thank you so much, sir.
Ritu ma'am, there is a
for
query
such a
from
wonderful session. Members, yeah.
Should I read it out? Sir, she's asking, so this means trading
So, sir, one question is there. Yeah,
this means trading in security
sir, please.
is to be considered as part of turnover to calculate audit applicability.
If it is business income, yes. Because business income, so audit requirement applies only when you are having it under section 44AB, business turnover.
Members, if you have any query or you want elaboration on any points, you can please post it in the chat box.
Sheetal, I think there is no query. Let's conclude.
Yes, ma'am, we can proceed for conclusion then.
Yeah. Rinkesh sir, I think अभी break लिया है. Yeah. Thank you so much, sir, for taking out time from your busy schedule to grace this meeting and share the wealth of your knowledge. With this, I request CA Sheetal Sharma to present formal vote of thanks to our today's speaker. Sheetal, over to you.
Thank you, Ritu ma'am. Indeed, today's session was a leading edge with the topic of taxation of financial interest. I thank sir on behalf of everybody from our Bhayander CP study circle for gracing his important work and sharing his finding and opinion with us today. The practical exposure along with example is exemplary, especially in depth and in a detailed knowledge of RIAT and various other trusts, with interlinking of the sections at one place, also quoting of the various case laws. I'm sure our participants have lot of takeaways from today's VCM. I'm also sure that our members have thoroughly up to date for this taxation of financial instruments. I also thank our participants for their active participation and patient sharing. Sir, thank you so much for resolving our queries for the members. Thank you all.
Thank you so much. Thank you for having me here.
Rinkesh sir, there is one request. Actually, members want PPT. So please share this PPT with our members.
I'll share it with you and maybe give me a day's time and I'll share this.
Okay, sir. Thank you. Thank you, sir. Thank you, members.
Thank you.
Thank you, sir.
Bye-bye.